Thanks so much for tuning in to Talking Point. I'm your host, Niraj Shah. Our guest today is wonderful to talk to because he combines macroeconomic factors, equity market indicators, the market themselves, and mutual funds. All of them with aplomb. In fact, we rarely get a chance to talk to him about corporate behavior and corporate profitability too. We'll probably try and talk to him about that as well. But a conversation with Nilesh Shah is never too dull, and today I don't think will be any different. Nilesh, so good having you. Thanks so much for joining in. Hope all is safe.
Everything is safe. Thank you, Niraj.
Okay, great. Can we just start off with your thoughts around this kind of recovery that we've seen? Because come March and across the world, I mean, not just Indian markets, we could not see any positives, and now we're on the break of breaking into the black for 2020. While the other markets have done this earlier, it's remarkable that India, with very little stimulus as well, has managed to do so. What's your sense about this recovery, and can it extend itself or not?
So right now, momentum is positive based on flows, but eventually fundamentals have to play. The recovery undoubtedly is attributable to fiscal and monetary stimulus. RBI, by providing liquidity and cutting interest rates, have supported economy. Government, by providing fiscal stimulus, have supported economy. And that has given confidence to investors, domestic as well as global, to put money into Indian equity market. These flows have pulled the market higher from March lows, and somewhere the hope of fundamentals improving is sustaining it. If we see September data, GST collection came at 4% higher than previous year. Fuel consumption is almost reaching Jan 20 level. Power consumption is higher than previous year level. So data is now supportive of recovery, and hopefully what we saw in September will get sustained in October and November due to festival season. And thereafter vaccine will come into play and this recovery will be sustained.
Actually, Mr. Shah, can I ask you if you also believe that whether we are entering a period of very good print coming in, and will that keep the sentiment? As you said, festive season. You added the vaccine bit, but I was going to tell you about how Shaktikanta Das referred to Q4 as being the quarter wherein the GDP will break into the black, and then Q1 and Q2 of the next year will have the favorable base effect of the current first half, which was very, very down. So are we entering that favorable print period, and will that keep the sentiment afloat? I'm just trying to understand if the markets have tailwinds of sentiment for the next 12 months, according to you.
Right now, market does have sentiment. There is a segment of society which is not able to spend money and hence has higher surplus. They need to invest. Globally, alternative deployment of money in fixed income or other instrument has become extremely low return. Hence, people are willing to take higher risk for generating that higher return. Put both these things together, market is trying to be on the positive mindset because your alternate return in fixed income is very low.
Yeah, well, the Tina factor. The small the small other question that I have, Mr. Shah, is also about the stimulus. Now, I do not know what side were you on in the past, but Sanjeev Sanyal mentioned that there will be maybe a stimulus coming in at an appropriate time. My question is, would you reckon? I mean, and there are some people in the fund community as well, which believe that in order to ensure that we get a good exit print on the GDP in quarter four, some bit of stimulus would be necessary as long as we don't stretch ourselves too much. Do you reckon a formal announcement of such a thing is necessary, or do you think that via the PLI schemes, via some of the other measures that the government is taking out, in some ways there are doses of stimulus anyways being given, which are large in nature, just don't get branded as formally stimulus?
So I don't think so. We have a choice of, we have to throw every dart to achieve growth. Now, on one side, we need to bring companies which are relocating from China to India, and PLI scheme will be one such incentive for them to come over here. On the other hand, I also have to give incentive to stress sectors in local economy so that they can survive this downturn. Both of them are necessary, they are not mutually exclusive. Now, one reason why government probably delayed fiscal stimulus on a sector specific basis was to ensure that supply is in place. Otherwise, stimulus would have raised demand, but without adequate supply, it would have resulted into inflation. Now that supply is falling in line, I think there is time to give sector specific incentive which has maximum multiplier effect, and through that combination we can ensure that our local economy is coming back onto the growth momentum as early as possible.
Okay. What about your sense, Mr. Shah, about what corporate India is saying? I mean, whatever little we hear, the sound bites are positive and not necessarily only from the export oriented themes like IT, but from some domestic oriented themes as well, two wheelers, for example, or some others. Do you reckon that the earnings growth, which has remained elusive thus far for the last 4 or 5 years, and I'm not even talking about the first half because that's not an extraordinary situation, but can this come back in some parts, show signs of coming back in the current fiscal year itself, or will it be delayed to FY22?
So we will see definitely margin expansion as costs have been cut dramatically. For example, in IT sector, in absence of travel and business promotion and sales and marketing expenses, their margin expanded. That may not be true for manufacturing company to that extent, but undoubtedly every successful company in corporate India is cutting cost, and that's going to result into margin expansion. Now, margin expansion may not mean profitability growth because your top line is still under constraint. But if you can maintain this cost control, then the margin expansion eventually will result into higher profitability growth, which is remain elusive. So my feeling is that FY21 obviously will be a write-off here, but FY22 we could see sharp earnings growth, partly because FY21 base will be lower, and partly because of this cost control resulting into margin expansion.
Okay. Uh, okay. Two or three is thematic questions before I move to macros, and I also want to talk to you about funds and the whole AMC piece as well. But just before that, two or three thematic things, because we usually don't talk to you about those. I want to use this opportunity to talk about that. I remember a conversation that we had, I think at a BQH event, if I'm not wrong, in Bangalore some time back, wherein you had said that you thought back then itself that spaces like specialty chemicals, select pharma manufacturing, etc., are showing to your mind signs of promise. Now, everybody is talking about manufacturing being the big theme and pharma, API, specialty chemicals being at the forefront. Do you reckon that the juice in this in these themes is still alive and kicking, and is it a multi-year story, or do you reckon that they've kind of run their course for the time being, looking at the valuations?
So the answer is actually yes and no. Yes, because the growth story will continue. To my mind, chemical, specialty chemicals, contract manufacturing, and pharma is a multi year growth story. We will continue to capture global markets. Players are investing for expansion of capacity, and they are going to get into more and more economies of scale, which will bring them further orders. So this is from a growth point of view, multi-year story. Now, why did I mention no? Because valuations have risen very sharply. From the time when we spoke, chemical specialty chemical stocks will be up 2, 3, 4 times. Now, they are factoring in a lot of positivity. Maybe chemical companies will continue to deliver on those positivity, or maybe there will be ups and downs. So my feeling is that while business will continue to grow over next couple of years, share price may still show little bit of volatility, At this valuation, they are pricing in almost all the growth.
Would you say the same, Mr. Shah, for information technology? Because, I mean, the industry captains are saying that this is maybe 4.0 or something, and we have a multi-year recurring growth cycle which is not been seen in the past, etc. I think Chandra was on record saying something else as well. What's your thought?
So at least from the IT sector, valuations have moved up from the lows, but it is still not expensive. If we see the corporate profitability pool vis-a-vis market cap, then IT sector does not look overvalued compared to, let's say, pharma or chemical space. Pharma and chemical contribute far lesser profitability to the profitability pool and yet have higher percentage of market cap. IT contributes far higher profitability pool, yet has lesser market cap. So purely, thumb rule, corporate profitability versus market cap, IT does not look overvalued. And if, as the IT industry's captains are explaining, this growth momentum can continue, then there could be still some juice left in the IT sector.
Okay, my last question on themes before we move on to the others, Mr. Shah, and that is what about BFSI. Now, in the affidavit filed in the Supreme Court, I think the RBI has warned of risk to the sector if the stay on the classification of bad loans isn't lifted right away. It's refused to extend the moratorium on loan repayments as well. What's your sense of the RBI's stance on this, and the resultant outlook that equity participants may have on banks, and the issue around the asset quality or the lack of it, maybe because it's been handled well in the second half for BFSI in India?
So from a market point of view, they will be looking at BFSI sector on an individual basis rather than on a sectoral basis. Each company has different credit culture. Each bank NBFC will have different NPA cycle. So people or market will try to focus on individual banks and NBFCs rather than taking a broad sectoral call. Second, RBI obviously is trying to maintain what we can call is the basic nature of banking. If you are paying interest to depositors, then you have to charge interest to your borrowers. If you skip on one side, the other side will have to suffer. Now, what we actually need is some sort of intelligent restructuring where the needy person gets the respite. His business has suffered in the lockdown. He needs that ballooning in repayment of his liability or deferment of his interest so that his precious cash flow is used for restarting the business, taking the business to greater heights. And then, as and when he starts getting into surplus position, he starts servicing his debt. In 2008 crisis, needy as well as non-needy persons were given money. This time we have to learn from that experience and ensure that needy people get the necessary space, whether it requires deferment of interest, ballooning of repayments, whatever the case may be. At the same time, those people who don't need it because they have gold-plated their borrowing or they have siphoned of money, let those guys, pay for it. But let's protect the needy guys. That's how this banking crisis can be solved.
Mr. Shah, if anybody you have a voice to the ears of the powers to be in this country, would you reckon something like this can happen? I mean, I'm not asking you to divulge anything that might not be apt to do, but would you reckon that moves which are actually beneficial and can make an impact are in the offing?
So if we see the Kamath committee recommendation, if we see how banks have supported businesses, clearly there is a lot of discretion. It's not open for all. And companies which have genuine business model where promoters have really worked for the business, they are getting their refinancing or they are getting their reschedulement. But many others who are of dubious character, they are not getting anything. So I think this is a fantastic move where needy people are getting the support which they require, and dubious character are paying the price. If we see all those scandals which are coming out right from Cox and Kings to Diwan Housing, I mean, that cleaning up of the system was necessary, and I'm glad that it is happening.
Okay. Before we move on to funds, Mr. Shah, because that's a hot topic as well, just one last question on the economy and the print as well. Would you reckon that the measures that have been announced thus far, I mean, the PLI scheme is a great scheme, right? But it won't come without some bit of cost. Whatever the cost, defined cost is, it will come with some bit of cost to the fisc as well. There is some bit of agreement that the center and the states have reached with regards to the GST proceeds as well. My question is, are you in some fashion or even a little fashion worried about all that the government will have to do in order to kickstart or jumpstart the economy, which is all necessary, but having an impact on the macro print, particularly the fisc numbers? Could that become a problem, even if there is no way around it?
I don't think so. We have to worry about fiscal. Our fiscal situation should be looked in relative terms. Every country on the earth is today raising fiscal deficit to support their economy. US, EU, Japan, China, everyone has loosened the purse to support recovery. In fact, India is probably one of the few countries which can fire multiple bullets to take care of recovery. For example, how many countries in the world will have their 10-year government security going at 6%? There is immense room for rate cut to support recovery. How many countries in the world will be sitting on a gold reserve like Indians are sitting? Now, this gold is in Tijori. It needs to be brought into the white economy. A good amnesty scheme will bring taxation to the government to bridge fiscal deficit. It will also bring equity in corporate balance sheet, business balance sheet as money moves from Tijori into white economy. And the same gold can be leveraged from the banking system without the worries of NPA to kickstart recovery. This option is not available to probably any other country in the world. The third thing is related to divestment of government assets. Our government is sitting on huge amount of assets like the land at railway, defense, transmission lines, roads. The same can be privatized like in the 70s and 80s UK did under Margaret Thatcher. So there are various options available to India from monetary side, from gold amnesty side, from monetization of assets side, uh, even divestment if we do it better. For example, our divestment route right now is market divestment, and that has resulted into derating of public sector units. If we pursue the path of strategic divestment, these PSUs can be re-rated, and the appreciation in the value of PSU stocks will be able to fund your fiscal deficit. So there are multiple options available for us to spend money without raising fiscal deficit if we can be innovative.
Okay, well, let's see if we are. And the divestment proceeds or the divestment schemes seem to be right here around the corner. Let's wait and watch how the government shapes up with that. Mr. Shah, last couple of questions. And that's on the mutual fund side as well, since you, of course, have been reappointed as the head of AMFI too. So just want to take this moment to try and understand about what's your thought around how should an average retail investor approach investing currently right now, not just on the equity side, but also on the debt side, because the last 6 months, there has been a deluge of noise, right, around how, and maybe rightfully so in certain cases, that an average SIP investor has probably only seen break even or not even that in certain cases. A credit or a credit risk fund investor or a debt fund investor has seen one or two instances which may have soured the mood a little bit. So how does somebody try and filter out the noise and try and make a sensible decision on the investing side when it comes to mutual funds?
So, Neeraj, my recommendation to investors will be do your homework and separate data and facts from the noise. Today, in this interconnected world of social media, people are twisting data and putting out any conclusion. For example, in the month of March, when markets corrected, a lot of people posted how equity funds have delivered negative return. In the month of April, when one mutual fund announced winding of six schemes, a lot of noise was made around redemption from debt fund, not only credit risk fund but also debt fund. A scare was being made into investors' mindset that you need to move out of mutual funds, debt mutual funds, even though the problem was with the credit risk fund. Thereafter, in May and June, we saw huge noise on SIP returns showing March performance, how SIPs had delivered negative return, how SIPs are delivering lower return. Now, today, we have just moved 3-4 months away from all those noise, and where are we? People who redeemed in March lost out a great opportunity. Markets are up 60% from that. People who redeemed from credit risk fund, they have lost out because except the month of April where credit risk fund delivered negative return because of redemption pressure, April, May, June, July, August, September, credit risk funds have delivered double-digit positive return. Whatever was the loss in April has been recovered, and people have made more money if they remain invested. People who redeemed or paused their SIPs in the month of March, April, May, if you look at today's number, in many time period, SIP returns are into double digit. In some time period, they are into higher single digit. If this recovery continues, will SIP return improve further? Answer is undoubtedly yes. So by following noise and by not following data or facts, you are being misled. People who made these wild claims on social media, they are not accountable to you. Your mutual fund distributor, your advisor is accountable to you. So listen to your mutual fund distributor, listen to your advisor, do your own homework, and take a call based on data. If the market comes down, equity funds returns will be negative. The same market when bounces back, equity funds return will be positive. If in a bear market you calculate SIP return, it will be negative. The same SIP, if you continue or top up, in a bull market, same SIP returns will look very fantastic. If there is a problem in credit risk fund of one fund, it doesn't mean that every other fund will have the same problem. Look at the portfolio and take a call. If a fund is segregating an asset or if a fund is writing down an asset because it has delayed payment, it doesn't mean that you are going to lose 100% of your capital. There is security enforcement. By enforcing security, we will be able to recover money. I think the most important thing which an investor has to do is to invest in a fund looking at his time horizon, which is in line with the fund's investment horizon. You don't invest with a 3-month view in credit risk fund. You invest with a 3-year view. You don't do SIP with 1 year or 2-year or 3-year view. You do it from a bear market to bull market cycle. That's the way to look at SIP. So do your homework. Don't get led by noise. I think that will do a wonderful to your portfolio.
Okay. Mr. Shah, I'm throwing this one last question out of the blue at you. Again, I don't know if you have an answer to this. You may not have, in which case, feel free to not give me an answer. But there is a big thing that has happened in terms of the delisting issues that the country faces as well in form of Vedanta, wherein uh, to an extent, the difference between the unconfirmed and the confirmed bids also led to, at least as per our understanding, the first half or the probable of the delisting not going through as well. Do you have any view on how that episode unfolded, and can some things be done in order to simplify the processes? Is there a need for that? Any thoughts on this?
So I don't have any specific comment on this episode, but I just want to make one observation. Our whole process is that we don't punish the guilty, and we try to tighten the law so that things doesn't repeat. Now I think it is extremely important that we punish that 1% who is guilty, and we punish it so exemplary that balance 99% starts following the law in letter and spirit. By making laws for lowest common denominator, we are inconveniencing 99% people who want to do business honestly. Let's punish one person and ease the burden of compliance and regulation on the balance 99%. If someone has done something wrong, punish so exemplary that it serves as an example for others. Right now, the example is that if you do a bigger crime, you will get away, and then rest of us will continue to face burden of compliance. I think we need to change this perception, change this concept.
Okay. Well, in some ways, I hope people get the message too as well. I can read a little bit between the lines, but we'll leave it at that, Mr. Shah. Thank you so much for taking the time out and speaking to us. It was wonderful talking to you today.
Thank you.
And viewers, thanks for tuning in to this edition of The Talking Point.